Hello, ladies and gentlemen, Greg McCloskey from ForexLive.com. This is a Kickstart video for December 13th, 2023. It's FOMC rate day, so let's get started. The Federal Reserve meets at 2 p.m. Later today, and, well, they're meeting right now, but they announced their decision at 2 p.m. later today, and that is going to be the driving force for the currency markets and stock markets and bond markets going forward. The Fed is expected to keep rates unchanged, but they're also going to be releasing things like their dot plot, which outlines the expected Fed funds rate at the end of 2024. Last time they announced it in September, it was at 5.1%. We'll see what they think going forward. That's not what the market has priced in, by the way. So we'll see if that number comes down or stays the same or does whatever. I don't know. It could be anywhere, actually. Then they also announced things like the CPI or the PCE, expected inflation for 2024, GDP, employment, so on and so forth. Those are called the central tendencies, or really it's the Fed's projections of what growth, inflation, and employment will be in 2024 and beyond. So it's going to be very interesting, and we'll see also what the Fed Chair Powell has to say. But anyway, looking at the euro versus US dollar from a technical perspective, this is just a price action versus the technical tools that we apply to these charts. When you look at the euro versus US dollar for the today's trading, we did try to get below the 100-hour moving average. It needed to get below that level with momentum, and you can see that it ticked down below the level in the European session, but could not sustain much momentum, and the price started to rotate back to the upside, and the sellers turned the buyers. And the PPI data, which just came out a little bit weaker than expectations, sent the euro versus US dollar up. But where do we go? We run right to the 200-hour moving average. That level comes in at 1.0800. Nice little round number there for that. That going into the FOMC rate decision is moving to the low downside. But what we know is that these two moving averages are going to be our barometers for more bullish above and more bearish below. And coincidentally, below on the downside, if we break below the 100-hour moving average, we have this blue step line right here, which is the 100-day moving average. And we get below that level, and we start to look toward these other targets, including the low prices right through here. This is, I guess, Friday and Monday's swing lows on the hourly chart at different times, and then we have the low price from last week's trading at 1.0723. So that would be the progression for the euro versus US dollar on the downside. If the US dollar would start to move up to the upside, that is, the Fed chair statement, central tendencies are all more hawkish, then we could expect the euro to go down and the dollar to go higher. Now, conversely, I mentioned that the 100-day moving average was coincidentally below the 100-hour moving average. Well, on the top side, what do we have? We have the 200-day moving average. That's a green line right here, this green step line, and it's almost equidistant from the hourly moving average. Not quite, a little bit farther move to the upside, but that level comes in at 1.08254. And note that yesterday the price after the CPI data, there was a weird spike to the upside with dollar sold off after the CPI data, and the price moved just above the 200-day moving average and said, no, go lower. And so getting above the 200-day moving average would be more bullish, and then above that level is a 38.2% retracement. So the levels are in play. We're in this neutral zone right here in between the 100 and 200-hour moving average. If we would have paint a picture of where the price should be before a key economic release like the FOMC rate decision, this would be about where you'd expect it to be, and that's exactly where we are. We'll see what happens between now and then, but certainly the barometers are going to be the hourly moving averages and then the daily moving averages on the wide here, break above or below the area, and then we should see further momentum in the direction of the break. Let's take a look at the dollar versus yen next, and we take a look at the 4-hour chart. We saw the market early on Monday, or on Monday into Tuesday, move to the upside, and then the price high reached into this swing area here. The swing area goes back to, way back here where the price had some different lows and swing highs through here. We traded above and below this area before moving to the upside here, and then we came back down to it a couple weeks ago. Found some support buyers here. Admittedly, we went a little bit below it here, but then reestablished resistance here before its plunge last week here. And in trading this week, we came back up to that swing area. So getting above that area between 146.53 and 146.65, it looks like will be more bullish. And then we look toward the 50% retracement of the move down from the high right here. This is the November high to the low price that we saw in December. That level comes at 146.77. Now we're well below that level at 145.35, trading above and below the 38.2% retracement at 145.55. So, that's what's been happening in trading here today on this 4-hour chart. That's going to be our barometer for more bullish and more bearish. Basically, if the Fed is more hawkish, we should see the dollar yen move to the upside on higher interest rates and such. So that would be more bullish. We'd start to look then toward the maybe this high right here, 145.88, and then the 146.22 low price, which is this low right here, and then look up toward this swing area. So that would be the progression to the upside, culminating with the 50% retracement as sort of the midpoint, key midpoint for the pair. Conversely, on the downside, if we stay below the 145.55, if we get a more dovish Fed, then we look toward this swing area down through here. This swing area comes between 144.40 and 144.54, and you can see it goes back in time to these different swing lows. We basically formed a floor right through here with a low here, a low here, low here. Each of this time the price moved to those levels. We found support buyers. We broke below it in trading last week, and then tried to hold below it, but could not sustain that momentum to the downside, and sellers turned to buyers right through here, pushing up. And in this week's trading, the below price came toward it, sniffed it, and rotated back to the downside. So we need to get below that level to increase the bearish bias for the dollar versus yen. So keep that level, that area in mind. Finally, let's take a quick look at the sterling versus US dollar. And this pair is having its ups and downs, if you will. And I'm going to put a box around this right around here, where we have a ceiling developed up here. That's pretty well defined at 126.13 or 14. On the downside, I put the box at the 38.2% retracement because of a trend type move. You like to see the price get below the 38.2% retracement, and we did here, and we did here, and we did even today here, but we could not sustain the momentum to the downside. We're back into the red box here, right here. So we need to get the price up below that 38.2 and get down below the 200-day moving average, and then toward the 50% 100-day moving average to increase the bearish bias. On the top side, if we stay within this box, the 200-hour moving average and the 100-hour moving average become targets to get to and through 125.59, 125.90, and then we got to get outside the ceiling here at the 126.13 level. So within the red box here for the sterling versus US dollar, looking for the break and run. The sellers have admittedly tried this week, but haven't been successful in keeping the momentum to the downside. We'll see if that changes later today or as the day goes on. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.